Hi, well, hello everyone. Good evening. Welcome to Malabar Hill Capital. Thanks for joining at night. I know your time is valuable, and so again, truly appreciate it. I'm Manong Desai, and joining me is Chris Merchant. Both of us together are the founders of Malabar Hill Capital. We're a Houston-based company specializing in retail and land development projects. Our focus primarily is in the Houston market, where both Chris and I live. But most recently, last year, we have jumped into the Austin market as well. Our goal is to create multi-tenant retail projects of the highest quality. If you don't know what multi-tenant retail is, I hope that we've described it in detail by the end of this webinar. We achieve this through two main strategies. Our first strategy is going into high barrier of entry commercial land and master plan communities. If you're from Texas, you're very familiar with master plan communities. This involves transforming these land parcels and large communities into development sites that users can use, no pun intended. So gas users, gas stations, fast food, of course, retail, which we develop. Other uses include schools, any number of them. Outside of that, the second strategy is, of course, developing retail strips, 15 to 20,000 square feet on a portion of our land development. And by capitalizing on high visibility and being proximal to homes, and also, of course, catering to fast-growing markets in these areas. We're committed to achieving superior risk-adjusted returns. I know that's oftentimes an overused term. Also, hopefully by the end of this webinar, we can shed some light on what risk-adjusted returns for our investors mean to us, and delivering best-in-class spaces for our tenants, so high-quality buildings. So let's jump into the webinar. I'm going to share my screen, but just some housekeeping things. I've turned off the video and the mic because this is recorded and will be posted, and so for privacy reasons. Now, having said all of that, the chat is open. You all are welcome to ask questions. We'll try to answer as many as that we can toward the end of the webinar, and we'll try to efficiently go through this presentation. Let me share my screen here. Give me one moment. Okay, perfect. Are you all able to see my screen?
Yes, Manan, I think we'll see.
Okay, perfect. Give me one moment here. All right, perfect. So just a little bit about our portfolio, just to kind of remind those of you all who are unfamiliar with Malabar Hill Capital, Chris and I, while Malabar Hill is relatively new, we're 2.5 years old, neither Chris or I are new to real estate. Chris has developed 500,000 square feet, over 500,000 square feet of commercial real estate in the Houston market, including hospitality, multi-tenant retail, climate control storage, continues to manage a number of those assets in the Houston market. For myself, I'm a physician by background, but large in part, my career has been in the acute healthcare space, and a large component of that was large-scale healthcare real estate development as well. Presently, we have 15 active projects. That includes our land and retail developments on top of the land. In the pipeline, 165,000 square feet of retail development on approximately 55 acres of commercial land development. Just a kind of quick review of what we're going to talk about today. We could talk about real estate for hours, but what we're really going to just touch on is a diversification strategy and how Malabar Hill's assets fall into that. And then just a little bit of insight into different real estate asset classes. So we'll take about 15, 20 minutes talking high level about real estate. and then take about the same amount of time talking about Sunterra and Sierra Vista, which are our newest developments. So what are the perks of real estate? A lot of you all are probably investors in real estate or have been in real estate or heard about real estate. Some of the obvious ones that a lot of us are what we hear about is passive income. And of course, over time, most of the time, real estate goes up in value. But if we were just to talk about all of our assets or a lot of us have retirement accounts and we put those in equities, there's bonds, there's commodities, and then what we call alternative assets, although real estate is not too much of an alternative asset, that is a primary component of diversification of your portfolio. And so, again, that's a part of what we're talking about today. I urge people to own real estate, shouldn't be your only diversification. And then we'll talk a little bit about each real estate class itself. One thing to add about being a sponsor of a syndication is um, some of the most important things that Chris and I do is educate one and then communicate with our investors about what our investment strategy is, or our development strategy, I should say, and then how we do exactly what we say we're going to do. But the other side of that is it's a bidirectional communication in that we need to understand what our investors are seeking, whether it's passive income or if they're looking for tax relief or if they're looking for both, along with diversification of their portfolio. Chris, do you want to mention most of your development career has been in real estate and what you love about real estate?
Yeah, so I think real estate is a tangible asset, right? At the end of the day, you can see it, you can visit it. There's a level of comfort in doing real estate, particularly in the state or a region where you're based out of. It gives you a sense of confidence when you can actually, go visit a property and because of those aspects of it being tangible and I like real estate, particularly in Texas, where there is ease of doing business, and also there's always a steady stream of investors that want to acquire assets. So there's always demand in real estate.
Perfect. I put this slide in to our presentation because a lot of these terms are in the discussion of real estate's often talked about, but oftentimes not completely understood in the context of risk. And we always say risk and reward, but return. And so I just wanted to kind of briefly touch on these terms. Um, and I think sometimes the easiest way to talk about terms is to talk about examples, and it'll give us a better idea or context as to what these terms mean, and then we'll kind of talk about it as we go through the PowerPoint presentation. But in real estate, oftentimes we talk about core assets or core plus assets. A core plus asset or a core asset, the easiest thing is to talk about a Chick-fil-A. Chick-fil-A's are operating businesses, obviously fast food, but the land and the physical building is a tradable or a asset, but they trade at a very low cap rate, which means they're very, very expensive. But that is a direct portion, crosswalk to how stable that fast food restaurant is, and so very stable, very low risk, but there's very low returns because it's a very high asset price. Core plus is a type of asset. It may be an office building, which is in a very good area, very good quality office product, but has maybe a little bit of vacancy and requires a little bit of tending toward getting the leases back up. But typically is a very good quality product. And what I mean by that is that it's not aged. It doesn't need a lot of capital improvements. If you stair step and you walk over to value add, a little bit higher risk, needs some significant improvement, capital improvement. We hear value add quite often right now talk about in the multifamily space, where asset needs to have a new roof or new appliances or a complete reconditioning, 20, 30-year-old asset, not anywhere close to the end of life, but still needs a fair amount of work. As you can imagine, more money you put in, there's also a higher risk that you may not be able to get all of what you put in out. Um, Talk about opportunistic. A good example of that also is in the office space where there's high vacancy and it may be a distressed asset, meaning that it can't cover its debt or it's in an emerging market and it needs extensive redevelopment. And it's a complex strategy to kind of get it off the ground again. So it's the highest risk. So, where do we fall, or where does Malabar Hill fall into this spectrum of diversification of assets development? So, for me to come to you all and say it's not without risk, all development is with risk. But as I said earlier, risk adjusted. And so, we'll talk a little bit about how we mitigate risk on our developments. Um, and the key to that mitigation of risk and maintaining returns is location, doing your homework, feasibility, market drivers, understanding your tenants, and then, of course, the financial aspects of it, whether it be the pro forma, meeting the hurdles that we're looking for to ensure that we're giving uh, consistent returns to our investors. The next four slides, we'll talk a little bit about each investment, or I take that back, each asset class. And each of these asset classes have, uh, how do I say it, spectrums or assets within them and themselves. So we're going to be talking at an extremely high level. Happy to talk further about it a one-on-one. Again, this is not a deep dive into every asset class. The real estate asset classes that we are not going to be touching on are those that are also businesses that are operating as well, like in hospitality. These are mainly landlord and tenant driven type of relationships in real estate. So residential, single family rental, as well as multifamily. This is a great entry or segue into investing into real estate where you can handle one or two houses. Multifamily is very popular because, from a geography standpoint, all your rentals are in one place. And of course, great stable cash flow, which is a positive, as well as tax advantage. But most recently, we've seen some of the challenges as it relates to a steady rise in operational expenses, particularly insurance in the Sunbelt states. In the I think biggest problem with operational expenses in the residential space is it's very hard to pass on those increased operational expenses efficiently to your renters. You can to a certain degree, but not necessarily cent for cent or dollar for dollar. Commercial real estate, it's commonly a very broad term. Sometimes retail is kind of strung along into commercial real estate. But in the context of this conversation or webinar, I'd like to think of commercial real estate large in part office. And to talk about office, I think with all type of real estate, every single asset class is cyclical, and within each asset, or real estate in general is cyclical, and each asset class within real estate has its cyclicality as well. We've seen this where um, during the pandemic, very early on, hospitality, and probably for the first 24 months of the pandemic, it was very challenging for the hospitality market. Has started to see a resurgence in the last 12 to 24 months. But conversely, residential real estate um, uh, had a very large expansion, particularly in the rental market as well. Office market, from a broad base, the behavioral change of the interaction between employer and employee I still think it needs to be shaken out, but I think it's going to be challenging for the foreseeable future for office. Industrial real estate. I actually really like this space a lot, particularly from Houston. Um, Somebody recently described Houston as the global logistics hub of the United States. And there's millions of square feet of industrial space being absorbed into the Houston market. A part of that largely is onshoring of manufacturing, but access to the ship channel, extensive highways and rail systems. I bring this up because um, what has this all equated to is a very large expansion in the job market over the last 5 years in Houston. Chris and I were at an economic development meeting, I think in the last 6 months or so, and each of the last 2 years have seen 120 to 150,000 jobs being brought to the Houston market, which superseded the last big surge in the job market, surge in the Houston market, which was in the 80s during the oil boom. The next real estate asset I wanted to kind of touch on, and then we'll talk largely about, is of course what we develop. One second here. Is retail real estate. I do want to take a little bit of time and want to tease apart the different subclasses of retail real estate because, and I'll let Chris answer this question best, but retail real estate is very broad. Um, we always think about big box, which is the Walmarts and the shopping malls. And we typically think of those as large anchored centers, regional draw, and they're typically selling goods, whether it be clothing or any number of different things. And again, that's a very broad term, but that's what we think about when we say large anchored centers. What we specifically develop in the retail sector is neighborhood unanchored retail centers. And I think it's very important to tease those apart because one, the tenants are different, and in large in part, the market drivers are different as well. Chris, do you want to add anything to that?
Yeah. So just as Manang mentioned, the main difference between anchored and unanchored is just think of your local grocer, right? These are large box. That's a destination, and all the retail centers surrounding an HEB or a Kroger would be anchored real estate or anchored retail centers. What we do is unanchored. So we're not next to a grocery store or Walmart or a big box like an Academy or something, but we are independent of those, and we sit in master plan communities. One of the difference that a lot of people kind of, it's the word retail. So retail in itself, our centers are more of service-driven tenants these days, and not so more like a retail. So when we say service-driven, we're talking about personal care. We're talking about restaurants, pizzerias. We're talking about medical. All these businesses offer more of a service than they actually do sell anything in retail. So as much as they're still called retail shopping centers, majority of the businesses and the tenants that are within these centers are more service driven. So that's a good way of looking at what we're doing.
Perfect. I appreciate that, Chris. The next couple of slides I wanted to share with you again, Malabar Hill being 2 years old, our first shopping retail centers under this syndication are finally being completed, as well as being occupied by our tenants. So what you see in front of you is our Sienna Plantation, 17,000 square foot retail strip. And what I want to point out, which is difficult to really get from the picture itself, is the quality of the construction. So we're very programmatic. There's developers that will switch from how they build their centers, whether it be like grade steel. If you can believe it, people still use wood construction. But we feel like, particularly in this market, we want to deliver the best product. Now, pricing is important, development cost is important. Chris has done an incredible job about value engineering to budget, if not below budget, for these two centers. Uh, and they're all tilt wall construction. And I think the most important thing is that exit for us, for our projects, is very important. And so we want to make an institutional grade product, and so that we're bringing the best thing to market for our investors. Chris, anything you want to add to that?
Yeah, definitely. As you mentioned, Manan, there is parameters to developing within master plan communities. So the master plan communities are well thought of townships almost, where everything has to be cohesive and the commercial has to be in line with the landscaping, with the amenities, with the homes, the design element that the master plan developer has in their vision. So for a cohesive look, we have to abide and play within the parameters of what we're developing within these communities to make sure that the product, by itself, the quality, but also the look of it is in tune with what's going on, across that whole master plan community.
Absolutely. And to reiterate, um, we have our municipalities, whether it be the city or county, but because we're developing the master plan communities, um, actually, when you're ready to go for permitting, you have to be very aware of the 120, 150-page book, all the way down to the exact type of plants that you have to put into the landscaping. So we're very particular, but I think it speaks to that what we're delivering to the master plan community is an amenity, and that amenity has to align not only aesthetically, but also deliver value to those people buying homes there. This center is on the northwest corridor on 249 in Houston. It's adjacent to a master plan community, but it's also in a large entertainment area right next to main event, another 17,000 square foot shopping strip as well. I was joking with Chris. I said, "Is there any piece of wood at all on this whole structure?" And he had a big smile on his face. It's all steel and concrete. Um, so we're prepared for the next hurricane. Let's put it that way. So again, I know that that was a pretty fast overview about real estate. We're happy to one-on-one and discuss about real estate. There's just so many facets of it. Um, but wanted to go ahead and jump into Sunterra and Sierra Vista. Sunterra is a master plan community on the west side of Houston in a city called Katy. It actually sits between two counties. That's how large this master plan community is. At full completion, it'll be approximately 7,500 homes. It's backed by Starwood Capital, which is a private equity out of Florida that has over 100 billion in AUM. I bring that up not because we're here to promote Starwood, but it is important for you when you're investing, where we're developing is in an area which is going to absolutely execute on what they say they are. Um, Not only from a commercial reserve where we're developing, but also from a master plan neighborhood. And we should also add that this community had the third highest number of homes sold by a master plan community in the whole country last year at 1,300 homes, which is an outstanding and incredible number to fathom 3 to 4 houses per day for a whole year during a very challenging mortgage environment. This is a satellite, or a drone footage from, I think, about 4 or 5 months ago. So there's a lot more homes delivered since then. Chris, if you want to talk a little bit about our master plan community strategy, I know we've alluded to it, but it's a large part of what we do, and I think where our success all largely comes from.
Yeah, so Sunterra in itself, we're really proud of this project and a little bit more about Sunterra. But in general, speaking about master plan communities, basically, when we work with master plan community developers, we are giving them an idea of what we plan to bring in. And the job of these people are to sell lots to homeowners or home builders, and then eventually the homes to the homeowners. The- They're, the reason why we were able to work with them is because these large communities, thousands of acres, in order for them to be successful, they're providing their homeowners a bunch of amenities, which includes tennis courts, which includes water parks and crystal lagoons and so forth. Well, one of the major important things that people need when they live inside these huge communities is the access to a cup of coffee, and access to a gym, a pharmacy, and your gas station. And so this is where we come in. When we land develop, for example, this 12 acres, we're bringing these amenities to the homeowners that would require this on a daily basis. So when we are putting in retail shopping strip, the tenants that come in are naturally serving these thousands of homeowners. And so we feel very confident that there's already a base for our tenants. There's a base of customers already built in that live around this area. Um, the market is very predictable here in master plan communities. We know where we're going in. It's surrounded by families that have a demand for different goods and services. And honestly, the location of these commercial reserves that are determined by the master plan communities are best in the location, are best in their communities, because they want the homeowners to have ease of access into these commercial sites. So in general, we love our master plan communities because it's already a predictable market, convenient location, and a base that's already built in. And in return, we have to execute to make sure we're providing the community with the amenities that they're expecting from us.
Perfect. And one thing to add, it's oftentimes comes up is how do you right size the retail development? So, where does 15 to 20,000 square feet come in versus, hey, put 30 or 40,000 square feet? Um, the best way to describe that is, the market drives what we deliver. And so through market analysis and feasibility, most of the time for master plan community of this size, 15 to 20,000 square feet is right size. If there's more demand, we can always do a second phase, but we don't want to necessarily over deliver to the market. Um, and also 15 to 20,000 square feet retail strips typically cost about $6 to $7 million to build. The exits are typically 9 to 10 million. These are very high level rough numbers. But the reason I bring that up is because we're merchant builders. So we build and we exit. And doing so, we know that there's a significant number of buyers in the sub $10 million range. And so we're form fitting to a certain degree and delivering not only shopping strips that we know that we can fill efficiently, but that we can also exit to the capital markets efficiently as well. Do you want to talk a little bit about this site plan?
Absolutely, too. Absolutely, what you just mentioned is also crucial. Is we're building with exit in mind, right? This is not a function of holding till the markets change or cash flowing asset. As Manang rightly mentioned, we're merchant builders and we build with exit in mind. So the reason to build a good product and to build a product that has an exit in mind is crucial to us. Um, Santerra location, we're very proud of. It's a large community, and we were able to get one out of the two commercial reserves, the largest commercial reserve within this community. It's a 12-acre tract that we closed just about a year ago with a different set of investors. Since then, we've gotten to work with our engineers in designing the site to best fit the different users. Our feather in our cap here is we were able to secure a a preferred builder for CVS to come in on the hard corner. So we are now looking to sell our main hard corner of this 12-acre site to CVS Pharmacy. We're in contract with them. We're also in contract with Everbrook Academy. That's got about 1,100 daycares throughout the country, actually. And this is going to be one of their next locations. So with the demand that's there, with the families moving in, they were one of the first people to approach us, and they wanted to be in this area. So we have both these users teed up. The third use will naturally be our retail shopping center. The multi-tenant shopping center, Malabar Hill has been working through entitlements or permitting and drawings for the past year. And we're at a stage right now where we're close to getting this one permitted. Sierra Vista is already permitted. But we'll talk about that in a minute.
So I think that's a very important point is that when a investor comes in on these offerings, they're investing in something that, in large in part, all the questions have been answered and are behind us. And the development should start pretty close to the time of closing on the land because we're basically have a permitted set for this shopping strip. Additionally, to add, as you can also see, we're out to pre-leasing as well in the last 6 months. So Sunterra has already 3 tenants lined up, including for the drive-through. So for our, we'll get to the investment terms and some timelines, but we wanted to present the locations first. So be patient with us here. Sierra Vista, master plan community, south side of Houston. If I mention Iowa Colony, a lot of people have some question marks as to like where that is. So if you're just going down 288, if you're a Houstonian and you go past Highway 6, the very next large intersection is Meridiana Parkway. It's quite incredible and amazing that between the exit on either side, there's approximately 15,000 new homes in the last 5 years. Sierra Vista actually is almost complete. It's also Starwood Capital backed master plan community at 2,500 homes. And its sister community, also Starwood Capital, is Sterling Lakes directly across the street. So approximately 7,500 homes, very similar to Sunterra in the same immediate trade area. We have 10 acres that we secured approximately a year ago. And now the retail shopping strip is what we're bringing forth to you all. So just to kind of give you context, 288, which is directly due south of Houston downtown, just outside of Highway 6. For those of you all who are not from Houston, Houston in its simplest form on a map is just concentric circles, 610 Loop, Beltway 8, and then 99. So I'll hand it back over to Chris if you want to describe a little about the site plan and a little bit about the building, and then some of the or adjacent pad site users.
Yeah, so this one is a little deeper than Sunterra. We're on a signalized intersection, Crystal View Drive and Meridiana Parkway. O'Reilly Auto Parts corporate has put under contract one of the pads. We're currently negotiating with 2 different coffee users and a QSR, quick serve restaurant, on the hard corner and the adjacent pad there. Learning Care Group is also a national daycare. We're already in contract with them on a site right behind the O'Reillys, where the future O'Reillys will be. And then we're proposing the 20,000 square feet multi-tenant retail. Shipley Donuts, as you can see on the plan, has already signed a lease for the drive-through and the end cap there. We're in talks with a very large pizza and wing concept that is looking to go in this area, and naturally so with the number of rooftops, it's an obvious site for them. So we're negotiating with them currently But yeah, this is one of the last commercial reserves around Meridiana Parkway, and the demand just keeps coming as it relates to commercial.
Actually, you brought up the signalized intersection. In real estate, particularly for retail, signalized intersections are very important. To a certain degree, it pauses traffic. So, and it's very important to retailers to be able to kind of steer the traffic into their sites just from a visualization standpoint. I wanted to step back and uh, I forgot to mention Sunterra is going to be also a signalized intersection. And Bartlett Road, while it does not seem like that on Google Maps, um, Bartlett Road is the direct vein to I-10 adjacent to the Buc-ee's near Cane Island. If you're from Houston, you may recognize what I'm talking about. Um, these large master plan communities, 3,000 acres, to assemble that much land, they have to throw a dart about 3 miles away from major thoroughfares. And then over time, the city kind of fills in between the major thoroughfare and the master plan community. And so it takes a little bit of not necessarily imagination, probably more patience. But in 24 months, this signalized intersection will be basically a drive to I-10, 3 miles south of it.
Manoj, you mentioned we just got word today that the land right adjacent or behind this Sierra Vista site, they're breaking ground on a large townhome. As you can see, right underneath the arrow, the townhome, 20 plus acres, is going to break ground within the next 60 days there. So that's going to be direct customer base for our tenants, almost walking distance to our new retail center.
Fantastic. And that's a land Tejas development too. I mean, Starwood development as well. So again, Sierra Vista and Sunterra, both of these offerings, some people have asked, why do y'all not put all these offerings into just one big fund? As much as that would be efficient. We've heard back from our investors, and oftentimes they like to invest directly into one versus another. We feel very strongly about both and the merits of both of these. In fact, as investments goes, these are probably the two closest. They're kind of like twin sister investments. They're almost exactly the same. So Sunterra, 18,000 square foot shopping strip. The raise is approximately $2 million in equity. That'll be used to purchase the land. The target investment period is 36 months. Typically, for our retail shopping strips, the first two was 42 to 48 months. Why is it 36 months? One, for pre-leasing. And then two, as I said, Chris mentioned, we have a permitted set as well. So there's no 1 year period of waiting to get a permitted set. Upon closing, we're doing a concurrent land and construction loan closing at the same time. As sponsors, all of our projects, Chris and I put 10% of all committed equity funds in. Our capital call is typically within 30 days of our land acquisition. Our minimum investment is $50,000. For our retail investments or retail center investments, there's an annual 8% preferred that is accrued and then is paid after along with a capital return at the end of the project. If there's cash flow before that, we'll of course pay out cash flow. The LP return typically for our retail shopping strips is approximately 18 to 20%. This one sits a little bit higher for the fact that the investment period is targeted to be shorter because the permitting period is shorter. Management fee. Chris and I are committed to keeping our management fees low. For the entirety of this project, it's approximately $60,000 to $80,000. So it's 1% of total equity at the time of organizing. and the disposition of the partnership, it's really just to pay transactional cost. And then retained capital is just 1% annualized. Sierra Vista, it's a little bit larger of a building, but the target raise is about the same. So Sunterra is 18,000 square feet. Sierra Vista is 20,000 square feet. The main difference from an investment standpoint, because the cost of the building, the physical structure is about the same, as the land basis is just a little bit different, and which is why Sierra Vista's annualized return is just a little bit higher. Um, Again, for use of and sources of funds, I'm happy to share that on a one-to-one basis. If you're a previous investor with us and you have access to our investor portal, you can jump in and look at the PPM as well as the company agreement. Um, in the chat, Shermeen, if you're not a previous investor with us, she shared a link. It's the investor link. If you fill out your information, I'll personally contact you, and we'll get you direct access into the investor portal, so you can take a look at the PPM as well as the company agreement.
I think it will be crucial to note that we already have teed up our senior debt, the loan for both of construction loan for both of these projects. In today's climate, that's a question that always comes up, is how's the project going to move forward? So to mention what Manang has already said earlier is that we do have permitted drawings. Sierra Vista is completely permitted. Sunterra is weeks away. And more importantly, we have senior debt on both of these projects already.
Yeah, and one thing I underwrite the projects in conjunction with the bank. Something that always comes up is this is a very challenging period. Interest rate's not 2%, it's not 3%, it's 8%. Prime is 8.5%. The most important thing as developers is we know exactly what the interest rate we face, and so we look at a lot of land, we look at a lot of projects, and a lot of them do not pencil out with the interest rate where they exist presently. So, real estate development is absolutely a function of math. And if the interest rate didn't make, if we didn't have the foresight of what the interest rate is, it would be very difficult and challenging. Another thing is we stress test our models where there's contingency built into all of our models as it relates to building soft cost, hard cost. We actually do a pro forma above and beyond where prime is, just in case. Of course, heavens forbid that would happen. As the interest rate continues to go up, at least we have stress test our models to ensure that we can still deliver a product in that environment. Anything you want to add to that, Chris?
Yeah, I mean, we're developers at heart, so we look at everything from a perspective of quality, of location, and more importantly, to deliver product that has value to an investor at time of exit. So all these play crucial role, and so we try to tee up a lot of these things even before we go out to raise. And Manang has a tough job of underwriting them in today's climate with today's interest rate. But because we're developers and we're not acquiring, there is a lot of inherent value that gets created, which in turn our investors can take advantage of.
Perfect. Let me just quickly run through the timeline. Of course, we launched about 2 weeks ago. If you're on our email list, you will have seen that. We're taking this month to educate, taking commitments already. At April will, large in part, will be our subscription period, although we're already, like I said, into that, and capital raise will end. And then we'll look to May 2024 to close on both of these projects. If there's any questions, like I said, Shermeen has put our website information out all there. If you got this through LinkedIn. Of course, if you're on our CRM, our investor, you know how to get in touch with us. This is our um, uh, personal information. So, if you text me, I'll call you back. I truly believe in that. I'm the person who does all the investor relations. If there's a project development question that I can't answer, I'm happy to get Chris on the phone. Like I said, as sponsors, our biggest job is educating and communicating. And we really want our investors to um, understand what they're investing in. And that is not a kind of facetious. I mean, we truly, truly mean it. Because if you understand what you're investing in, you're going to feel very comfortable. Real estate is not for all, but I think it's a wonderful asset. There's just a great feeling seeing something come out of the ground, particularly our last two retail strips. We're just very, very proud of them. We have a third one coming on in about 30 to 40 days. So I'll kind of open it up for questions. If you want to type anything into the chat, we're welcome to stay on. Again, this will be this has all been recorded, um, and we'll release it. If you're on this, you'll get the link. And we really truly appreciate you getting on. And if you like what you hear, we're a 506c, which allows for outside investors, which is why a lot of you all are on. Please pass it on. We'll reach out directly, and we absolutely aim to deliver on what we say we are going to do.
And then I have a question for you.
Mhm.
Are you able to get a free cup of coffee or a free haircut at one of our tenants in our center?
I hope so. Sure. Sam has a good question. We have not, for full discretion, within Malabar Hill, we have not come full cycle. So we have three retail shopping strips. All of them are pre-leased at Performa. We will look to exit all three of them late this year or early next year. So that's the Sienna Plantation, the North Point one, both of those pictures I showed you all, and then Aliana, which is off of 1464. All of those projects that you can see on our website. As it relates to an ROI, the return on investment, which is a ROI, is based on the net operating income. Just to kind of share a little bit with the leasing environment that exists right now, it's a tough time to develop. And what does that mean? There's not a whole lot of retail strips being developed in master plan communities. There are that are around anchored, but we're talking specifically within master plan communities. And so Houston's experiencing a very, very low vacancy rate, one, but two, the leasing rates are higher than they've ever been. And so we did a pro forma for all of our first three locations at approximately $30 per square foot. And all of those we've never actually signed a lease below 31 or 32, if I'm not mistaken. So we truly believe that all of those will be exiting about pro forma. Any concerns, strength in renting these with interest rates higher for longer and economy slowing down? No, it's a great question. We haven't seen that as it relates to leasing. Leasing continues to remain strong. An interesting effect actually is that Dutch Brothers, for example, would only develop freestanding buildings. And now they've changed a little bit of course and going into the end capped drive-throughs for shopping strips. What we have seen as it relates so far is that the tenancy is high, vacancy is low. Part of our exit strategy is selling to the market. And so the cap rates have increased a little with retail, but this is probably the most stable asset class as it relates within the realm of retail because it's sub 10 million and there's a lot of buyers. Is the land in the deal as it's valued at cost or market, considering 12 months have elapsed since purchase? It's a good question. It's not valued at the it's it's valued close to cost, but because there's improvements associated with it. So what do I mean by that? We bought the land, but we had to add infrastructure and access and permitting. So those costs are put into the value of that property. So they're being sold at market value because there's investors on the land side as well. So it's fair market value. Just to reassure the retail investors, I'm happy to share those numbers, but it's all being it's all transparent. It's all being sold at fair market value. Can you speak to the quality of the tenants that we have pre-leased? Sure. Well, Shipley's, as you can see, is a national name. It's a local credit franchisee, but most of them have, I don't know, this Shipley operator, is it 30 or 40 locations?
Yeah, this one's about 18 or 20 locations.
Got it. The Marco's Pizza is a multi-site operator. That's the drive-through for Sunterra. And there is a liquor store, which I think is 6 or 7 locations. And then there's a dental operator, dentist, that has, I think, 4 or 5 locations as well. So I think that's a very good point. It's very rare for us to sign tenants where this is their first location. There's just too much risk in them executing on their lease, even if they pay a deposit, what have you. And Chris can speak to that because he reviews all the leases and negotiates them.
Another function of what we look at when we're leasing is personal guarantees from the owners. So on all our leases that we've done here or our other centers, they're all basically guaranteed by the owners of the business as well.
Yeah. I think someone's asking about dollar per square foot. I think it's probably a little hard to answer. I'm happy to do that one-on-one. That's a broad question, but let's put it this way. Our construction costs have come in exactly at budget. And, we don't live in a silo, as we talk to a lot of builders, a lot of GCs, a lot of fellow other retail builders. And I'm very comfortable to say that Chris has done a great job about delivering a product at or below what our competitors are able to, I say our competitors, our other fellow developers are delivering. Having said all of that, we're also building below budget tilt wall construction. So there's no cutting corners as it would be with steel and concrete construction. As it relates to what the price per square foot of a fully built, we're delivering probably in the mid 300s per square foot.
Well, I think one more thing that needs to be mentioned here, more than just pricing, is the arm's length transaction. So unlike some of other developers that have in-house construction companies or in-house leasing or companies that sister companies that have architectural firm, we bid out each and every vendor and hold them accountable for their work, their pricing. So the function of pricing of the cost of construction is very transparent as it relates to Malabar Hill, is because we don't self-GC anything. We do not have sister companies that take advantage of some of this scope of work. We go out and bid it and make sure that we're getting a fair price on all of our construction and other things.
Absolutely. I hope I was able to answer everybody's questions. Like I said, my cell phone is there. All of you all are welcome to text me anytime. I'm happy to connect with any of you all in person. If you're in Houston, in person. If you're not in Houston, a phone call. I'm happy to go through in more granular detail each of these products. We want people to feel very comfortable with their investing in. if there's no more questions, it's wow, exactly 1 hour. How about that for timing?
Great job, Manan.
Hey, thanthanks everyone.
Thank you, everyone. Appreciate it.
Bless you. Thank you.
Thank you for your time.